Hi, this is Shane with the Rational Trader. It is Saturday evening, 9:30ish. Looks like 9:30, and we're going to talk about how we are analyzing the output of the machine learning system, and then using it to guide our choices in the trading environment, which has an element of randomness in it that we need to deal with. All right, and so what we're looking at on screen here is an output of the machine learning system for the last 110 days. And so what I did was I built a model that used data, and I gave the machine learning system data through June 17th. And then I ran that model against all of the trading since then. So 6/18 through 11/16 works out to be 110 days. Okay. And what I did is, members will understand this. I used a grid search that's part of the replay program that I built. And what it did is it just traded a single code, which is a code is a combination of price action and order flow that the machine detects. And from that, calculated, well, what would happen if I just took that code, and it gives me a profit number, how many trades it was, how many were long, how many were short, how many times did I take a maximum loss, and then total days and last date. So because each row represents a single code, it's only going to be long or short. Okay, so there's a whole bunch of them, right? And I currently have it sorted just by the codes themselves. Now we need to talk about what ER is, because it turns out to be really important. This is the profit in ticks. By the way, this is ticks. So this is oil. So you'd multiply that by 10 to get a dollar figure, divided by trades. And that equals ER. ER stands for efficiency ratio. So how efficient is that code? How many trades does it take to achieve that profit? All right. So you can see that 102 going short is better than 101 going short, right? Now, the tempting thing to do here is to sort it by profit, and then just grab all those codes. So let's see what that looks like. Data sort, and I want to. Let's see, I want to sort by profit, largest to smallest. And then I don't want this one. I don't remember how to get rid of it, though. Oh, there it is, available. Okay, so this gives us the highest profit amounts for the last 110 days. Okay. Now, it would be tempting to go, all right, I'll just, give me the codes for these ones that are making $300 or more across the 110 days. And that would be a reasonable thing to do, except take a look at this one here. So that made 34 ticks across 110 days, $340, but it took 69 trades to do that, which means you're taking a lot of losses actually. 0.49 is the efficiency ratio. So what that means is you took basically twice as many trades as ticks that you made. Not very good. All right. Compare that to say, this one here, where I took 10 trades and made 133 ticks, so $1,330. That's a much higher efficiency ratio, right? And so it turns out actually that you're much better off when you're trying to figure out, okay, well, what of the different behaviors that we see, which ones are have a higher level of predictability. It turns out that it's better if we sort by the efficiency ratio. So let's do that. And what we're doing is we're walking through the process that I went through to get to how I'm going to trade here. So now we're sorting by this column in descending order. Okay, this is across 110 days. All right, so it's a fairly large sample size. That's 22 weeks of trading. Okay, and now it gets quite a bit more interesting. Actually, I want to go back to the profit number first, because there's one thing I wanted to mention that I didn't. So let's resort that by profit. Okay, and now let's just add up, say the sum down to, let's cut it off at 30. That sum you can see down over here is 2161, 2,161 ticks, which in dollars is $21,000 across 110 days or 22 weeks. A spectacular number if you could achieve it. You can't, okay? But we want to use that number to compare sort of how we're going to change the way we look at it, right? When we look at it by efficiency ratio. All right. In fact, you could go even further and go all the way down to where it starts to get negative and just say, give me all those codes. All right, and that's 2427. Okay. So keep that in mind. Just hold that number in your head. Now let's sort again, this time by efficiency ratio. And now let's look at this, because basically what we want is we want the most amount of profit on the least amount of trades. Okay. And if you just cut it off at, say, 2, I won't take anything with the efficiency ratio that's less than 2, then, what do you get? That ends up being right, that's this line right here. So let's do this here. All right, it's that line. Everything above that line and above is an efficiency rating greater than 2. So that number in profit is 1947. It's awfully close to the kind of the total profit number where I've cut it off at 30 ticks, and regardless of its efficiency ratio. Here, we're not interested in trades where we have to take a lot of trades to get that number. All right. And so if we do this now this gets quite a bit more interesting now, because we have something to work with in terms of what is the most profit I can make on the least number of trades. This is across 22 weeks of trading, so it's a decent sample size. Now, what we need to do though, because trading the boundary conditions aren't known, because there's a large element of randomness in it, we need to understand a little bit better how this behaves over time, not just for one block of time. All right. So what I did is I ran the same replay, but only on the last 4 weeks. Okay. So that's here, the last 4 weeks. Let me clear this here. The last 4 weeks, and let's do the same thing now. Let's sort it by efficiency ratio. Sort on my list. Okay, here it is. Sort by ER, and we want largest to smallest. Okay, and so here we are. We've got ERs from 25 all the way down to 2. If we cut it off at 2, it's right there. Okay, so it's this group of codes. All right, so let's do this here. Whoops, wrong one. Let's just highlight that. All right, and then the sum, the profit, if you took those codes, is $685. So $6,850 across the last 4 weeks. Okay. And we're doing this not because that's what I expect to make. Hindsight is not useful, but what we're going to do now is compare these codes to the codes from the larger sample size, the 110 days. Okay, because what we want to see is we want to see which ones are more consistent than others. Okay, which ones? All right. So this was for the last 4 weeks, and now this list here is just last week. Okay, and the difference now is that this uses the model that was built through 11.9 through. This is last week's model that we actually ran live with. Okay, whereas these two were using the model that was built with data through June 17th. So that model's not updating every week. In theory, it's getting slightly out of date every week, right? There's there's more data it could have trained on, but it hasn't. The reason is I can't do that. It takes too long to train the model, so I can't add another week in and retrain and then retest. It's not feasible. But it gives us a good read on what we're seeing. And the other thing I can tell that I can't show because I don't have the files here on this computer is I can tell how much sort of drift there is between 1 week to the next, or between the model that was built through 618, the one that was used for these two charts, and the model that was built, using data all the way through November 9th. Right? I can see that when I train the new model. I can see how much is it now off by, basically. It's pretty interesting, actually. So we'll cover that in another video. So here's last week. Okay, so let's do the same thing. This is just 5 days now. You wouldn't want to use it for any kind of final analysis, but in a moment you're going to see how we're going to put all these three together and come up with an answer, or come up with a decision on how to proceed. So let's sort this by efficiency ratio, largest to smallest. Click OK. All right, and again, let's cut it off at 2. That's down here. And what is that number? That's 438, so that's a lot. All right. Looking at it, I would go, I'd probably want to, I'm kind of not interested in these little things. I'd probably cut it off up here. Be more reasonable. 357, so $3,570. I'd have been super happy to get that. It's a spectacular number. We're not going to get that. All right. That's, everyone can see what happened after the fact. What we're looking for is which of these sets of codes that we have here are more reliable. Okay, and so to do that, what we do is we take those codes, or we cut off at the efficiency ratio at a logical spot, but never less than 2, and then we put those together, and that's what we have here. Let me change this just a little bit here to keep us focused. I need to see that. All right, and so this first group is the 110-day group. Okay. This second group is the last 4 weeks, so that's the 20-day group. Okay. And then this last group here is last week, so that's 5 days. Okay, and the way it's color-coded is starting from the left and moving, starting from the right and moving to the left. What I did is I looked at each code and said, okay, well, which of these codes is present in all 3 groups? Okay, so you can see 164, 164. 164 actually is the only codes that's present going long in all 3 groups. So last week, the last 4 weeks, and the last 22 weeks. Okay. For the short side, there's more. There's 3. 293, 196, and 264. It doesn't matter what they mean. Okay. The fact is that they show up in all 3 samples. All right. Last week, the last 4 weeks, and the last 22 weeks. All right. So what would be very interesting now is to run a replay using just those codes and see what we get. Okay. And I did that. And that is what you see right down here. Okay. So this is green only the greens. So it's 1 code going long and 3 codes going short. All right. So for the 110-day group, the profit's 266. So that's, multiply by 10 for the dollar figure. That's this is oil on 89 trades. So an ER that's just under 3, and out of those 110 days, using that code set, so basically 4 codes, you took a max loss 2 days. All right. So that's max loss is $200. So we're trading, the trade management is listed here. All right, so minus 20 ticks is the daily max loss, okay? The trade management is important because it affects the different codes work differently depending upon how the market is behaving, right? So the entry offset is -2, the trail amount is 15, the stop amount is 10. The first target is, the target, not the first target. The target is 80 ticks out. You move the stop at 10 ticks to +5. Pretty unusual trade management for me. And then at 15, you don't move it. You just keep it. I originally had this at +10, moved to +1. Actually, I originally had it moved to -3, and then I went to +1, and then I went to +5, and this actually works out pretty well in oil. So anyway, using just the green codes, this is the profit across 110 days. This is the profit across the last 4 weeks, 133. On 23 trades, no max loss days. Okay, so if you can see, it's easy to see that's about a trade a day. 23 versus 20 days. Okay. And then last week would have been 8 trades, no max loss days, profit of 84 or $840. All right, using just the green codes. All right. Now I think that you can see where I'm headed with this. Is that it would be very reasonable to find these, what we would term reliable codes, or I guess we need to come up with a better term. But the green codes, the codes that show up in all the samples, and trade just them, but do it for 4, 5, 10 markets. All right, as opposed to concentrating on a single market with more codes. All right, that would be a very reasonable approach. All right, but there's other things we can do here that look interesting. So the other color coding that you see is this kind of gold color, and then there's this orange color. And the gold color means it shows up in two of the 3 samples. So either in last week plus the prior 4 weeks, or last week and sometime within the last 22 weeks. All right, or sometime within the last 22 weeks and within the last 4 weeks. Okay, so keeping in mind that these are the codes that only have high efficiency ratios, okay, from each of those times. So you can see there's quite a bit more now. If 295 is here, and then it's here, and then 102 long is here, and then it's where is it? Must be over here. Yeah, right there. Okay, so now it would be interesting. Well, what if I took the green and yellows and just ran with those? So exclude the oranges. The oranges mean I didn't find it in any other sample. Okay, so starting from the right to the left, 227 only shows up here last week. It didn't show up in the previous 4 weeks. All right, and it didn't show up. It didn't show up in the set of good efficiency ratio codes. All right. Same thing here. Like, then I get to working from the middle now. 127 only shows up in this 4-week period. It doesn't show up in this group or in this group. Okay. And then these blank ones over here, it's the same. These would just be orange. 102 only shows up. 102 short only shows up in the larger sample. It doesn't show up in the last 4 weeks or last week. All right. So what if I only ran with greens and yellows? What would that look like? All right. So, well, we have the tools now to do that. So that's what I did. And that's down here. I can move this down now. So what we do is what I did is I take all those codes and sort them by color and then remove the dupes, and I get that. And then I plug that into this for long and this for short. And then I plug that into into the replay program as the codes I want to trade. Okay, so for green and yellow, this is what I get for the last 110 days. 586. All right, so multiply by 10 for the dollar number. 14 max loss days. So 14 days you hit minus, you stopped trading because you hit minus 200. All right. Again, for oil, we're trading minus 20 ticks is the max loss. So the way the replay program works, as soon as you hit that, it doesn't take another trade. It's done. Analysis. Okay, and then so on 242 trades. So up here, green only, our ER was 299. Here we doubled the profit amount, tripled the number of trades. We had to triple the trades to get to do that. All right, still a decent ER. Okay, so you can calculate total gains by figuring out what your commissions are from that. Over the last 4 weeks, here's what it looks like. So 289 on 61 trades, max loss days of 2. So this is the number actually I tend to focus on the most, or almost the most, is what's the percentage of max loss days. All right, so because for the retail trader, when you're just getting hammered day after day, you just end up giving up. All right, so we want to kind of keep this number as small as we can while still allowing us to make a profit. All right, and so this, it turns out to be just over 10%. All right, or once every 2 weeks, if you just do the math. And you kind of see that here. Actually, it actually works out exactly the same because this is 4 weeks, 20 days. And 2 max loss days. And this looks very similar in that doubled, basically, and that tripled. So you have to get to 3 times as many trades to double the profit. ER came down a bit, of course, because you've got more trades. And then for last week, no max loss days. You a little bit more than doubled the trades to make maybe like 50% more profit. That's the way it worked out last week. So when I look at it this way, I'm actually pretty happy with this process of how to figure out, well, what do I want to, what behaviors do I want to look for in this market? This is oil, and then I'll plug those in, and that's what I'm going to trade. Okay. And then this is you can see how structured and logical the process is. I can re-execute this process as often as I like, right? But it would make sense to do it at least once a month. Okay. So this is oil. I'm gonna change my spreadsheet to have these codes in them, plus the greens, and start trading that. Now, I also did this for gold, okay, and that's here. So we can take a look at gold. Gold is the trade management is a little bit different. We use 7 tick stops, and we'll take 2 losses. So that's minus 14 ticks or $140. We trail by 20. Target is 80 ticks. We move the stop at plus 10 to entry plus 1. All right. And then that's it. All right. The same story. Do the replay, do the grid search, and then sort by ER, efficiency ratio. Copy those codes out and do that for since 6:15 to, it's actually 11:15, not 11:16, because I did this. I pulled the data for gold on Thursday in order to get all this work done in time. Here's the last 4 weeks, and here is last week. Okay, and then it's the same analysis, right? So you do the same thing. It turns out that there is one code that shows up in all samples, And in fact, you'll notice that it's pretty high up. 122 long looks like a good code for gold. And there's a one short, actually, 286 short for gold. That yields this profit across 110 days, $1,090 on 12 trades. Not that many trades. Okay, that's not even one a week. All right. Last month, the last 4 weeks, 19 days again, because I pulled the data on Thursday, so I didn't. Friday's not in the data set. Only 3 trades for 680. All right, and then last week, for Monday through Thursday, 2 trades for 62 or 620. So actually, this here is a subset of this, so you can tell there was actually 1 trade for 3 whole weeks, and then just 2 more. So you can see the problem if you restrict yourself to just these green codes, you can go a long time and not get a trade off. Now, if you're doing this across 5 or 10 markets, then maybe you don't care. At this point, we've got oil, gold, and the euros coming here. So, and the process is not that difficult to implement. So we'll see if we can get to that point or not. But currently, it's looking like we'll do green plus yellow, and not just green. That's what I'm going to be doing. So same story. Find the sets of codes that show up in at least 2 of the 3 samples. Color those yellow. Sort them out. Remove the duplicates, and then plug those in, and then run green plus yellow, not just green. All right, the green gave us that, right? So the green plus yellow gives us this. Okay, so across, this is gold now again, across 110 days, profit of 392, so that's 3,920. ER drops fairly dramatically. And the reason, of course, is that you went from 1 code to, I forget how many, let's see, 8. So, 8 times the number of codes. Max loss days of 13. Okay, so 13 days out of the 110, you hit minus 140. Again, it's very similar to oil. It's just over 10%, so it's a very reasonable number. The last 4 weeks, 1 max loss day. On 36 trades, 165, so 1,650 on 36 trades. An ER of 4.58, so that very nice looking, actually. And then last week, 7 trades for 790, ER 11.29. So this is what I've done. What I'm doing is I've built the gold and euro chart books. I've been trading those for the last couple weeks now. Last week anyway. And the difference here between oil is that for both the euro and gold, I changed that setting on the low volume nodes from 10 to 7. From 20 to 14. And that was to get more. I wasn't getting enough signals. Okay, brief interruption there. Okay, so what I'm doing is I changed the setting on gold and euro, and so I had to rebuild the models from scratch. And so all of this data is from the model built through 0614, the day before here. All right, so in oil, I was able to use last week's model on last week's data, but I couldn't do that here because this model hadn't been rebuilt from scratch. All right, so what I'm gonna do is do the same analysis here for the euro, for 6E, and then for members, I'll upload the charts and spreadsheets that have all of the appropriate codes loaded in, and the models. Okay, so we haven't put up gold and euro models yet, so I'm going to do that this weekend. I would really recommend that you sim it first. I would normally live trade it for at least a week before I released it to members, but we're at a point here where we can crowdsource it out. We can crowdsource it, and the early adoption group is intelligent and disciplined enough to follow the instructions, or at least be aware of what the risks are. Okay, so that's what you can expect. New chart books for gold and oil and the euro, with new spreadsheets that have the green and yellow codes loaded into them. Okay, which is what I'll be trading. I will put up the NASDAQ and ES models. I really don't think you should be trading those markets. They're too wild. That's why we're switching, why we're changing horses here. And once those settle back down, we'll basically do the same thing. We'll follow the same procedure here and find the behaviors that make the most sense to look for and then trade those. Okay, so that is it for today. And so for members, look for that. I'll send a message out. Look for that tomorrow night. Keeping in mind that next week is an odd week with Thanksgiving. So trading room will be open Monday and Tuesday, but closed the rest of the week. Take care.